What if I told you an insurance company actually doubled its revenue per employee, shrank its human workforce by 6%, and somehow still improved its customer service?
I mean, honestly, I'd assume you were pitching me some kind of sci-fi movie script.
Right, because normally when we look at a tech company growing at this kind of, breakneck speed, the behind-the-scenes reality is just super messy.
Oh, totally. Overflowing offices, armies of new hires, and
Yeah.
just literal fortunes burned on marketing.
Exactly. It's the classic Silicon Valley trade-off. You buy market share now, you burn through your venture capital, and you just figure out how to make a profit years down the line.
Yeah, growth at all costs, just assuming the economics will magically fix themselves at scale.
But when you look at Lemonade's Q1 2026 performance, the whole machine just looks different. I want you to picture a sleek digital dashboard.
Okay, I'm picturing it.
All the dials for revenue and customer acquisition are spinning furiously into the green, but the dial for employee headcount is actually ticking backward.
And their cash burn is actually turning into cash generation, which is huge.
Exactly. So welcome to the deep dive. Today, our mission is to unpack a really dense stack of Lemonade's Q1 2026 financial documents, investor decks, and shareholder letters.
And we're doing this because we want to see the actual mechanisms behind the numbers, right?
Right. We want to find out if this whole AI-first insurance company thing is finally turning its massive technological hype into, like, hard, undeniable profits.
Because if you're trying to understand what happens when AI truly collides with traditional finance, this stack of documents is basically your blueprint.
Yeah, and we aren't just talking about slapping a helpful little chatbot on a website.
No, not at all. We are looking at a fundamental rewiring of how a financial institution processes risk, manages capital, and, scales up.
Okay, let's unpack this. We need to start with the sheer scale of the top-line boom, because the numbers here are completely defying traditional business logic.
They really are. Where do you want to start?
Let's start with the total customer base. It hit 3,142,581. That's a 23% increase year over year.
Which is solid, but in the insurance world, the metric you actually care about is in-force premium, or IFP.
Right, the total annualized premium for all active policies. And that number reached $1.333 billion.
And the really crucial element to pull from that 1.333 billion is the momentum. This isn't just a sudden one-off spike from like a viral ad campaign.
Right, this marks 10 consecutive quarters of accelerated growth for their in-force premium.
Exactly. They are systematically stacking growth on top of growth, quarter after quarter.
And it's not just that they're shoving more people into the insurance pool. The people already in the pool are actually paying them more.
Yeah, the premium per customer is up 7%, hitting $424.
And the mechanism here is just so compelling. Think of it like your digital ecosystem subscriptions.
Like streaming services or something.
Yeah, exactly. You get into the ecosystem with a basic renter's policy, but then, you get a dog. So you add pet insurance with a few taps on your phone.
And then maybe you buy a car and you bundle that in too.
Right. The existing users are continuously upgrading their engagement. They're upgrading to the premium tier, essentially.
And that compounding effect within the user base leads directly into the revenue numbers, which honestly present a really interesting mathematical divergence.
I noticed that too. Revenue for the quarter hit $258 million. That's a staggering 71% increase from Q1 of the previous year.
But wait, let's look at those two numbers together. A 32% growth in force premium, but a 71% growth in actual revenue.
Yeah, that map doesn't map out cleanly at all. If the premiums they manage only grew by a third, how did the money flowing into their pockets grow by almost 3/4?
Are they quietly jacking up administrative fees or something?
You would think so. But the source material actually points to a deliberate structural shift in how they handle their risk, specifically their reinsurance strategy.
Ah, reinsurance, which is basically the insurance that insurance companies buy to protect themselves from, massive catastrophic losses.
Exactly. Historically, Lemonade used a strategy called quota share cession.
Quota share what?
Quota share cession. In simple terms, they would just give a large slice of the premiums they collected to third-party reinsurers.
Right, and in exchange, those reinsurers took on a corresponding slice of the risk.
So they were basically giving away potential revenue for a safety net.
Precisely. But recently, Lemonade significantly reduced those cession rates.
Why this sudden confidence?
Well, their internal AI risk models have become so accurate and their financial footing so stable that they just don't feel the need to hand off so much of that premium pie to outside companies anymore.
Oh, wow. So they're keeping a much larger piece of the premiums they collect.
Yeah. And by keeping more of that risk in-house, they keep the associated revenue on their own books. That strategic shift is exactly why revenue growth is so drastically outpacing premium growth.
I mean, I see the logic there, but I have to play devil's advocate on the top-line growth itself for a second.
Go for it.
When I look at a company adding massive numbers of users, I immediately assume they're just like plastering subway cars with ads and buying super expensive podcast placements.
Right. Anyone can buy top-line growth if they're willing to just stomach diminishing returns on marketing.
Exactly. And I'm looking at their growth spend, the money for customer acquisition. It increased by roughly 200%.
From $17 million in Q1 of 2023 to $54 million in Q1 of 2026.
Yes. That sounds exactly like a company just burning through cash to buy a bigger user base.
It does sound like that. But in traditional marketing, there's this concept of gravitational pull. As you scale up your ad spend from $17 million to $54 million, you inevitably exhaust the easy, cheap customers.
Right, so you're forced to reach broader, less targeted audiences.
Exactly. Your efficiency drops, and it costs you increasingly more to acquire each marginal user. But what's fascinating here is Lemonade's documents show they completely defied that gravity.
Define it how?
Despite tripling their marketing spend, their LTV to CAC ratio, the lifetime value of a customer compared to their customer acquisition cost remained rock steady at 3x.
Wait, meaning for every dollar they put into the marketing machine, they're still reliably generating $3 in lifetime value, even at 3 times the volume.
Yes, exactly. And the sources attribute the sustained efficiency to a proprietary AI-powered growth engine.
How does that differ from a normal marketing team?
Well, traditional marketing teams set a budget for the quarter and adjust it periodically, right? Lemonade's AI uses real-time capital allocation.
Meaning it's shifting money around constantly.
Constantly. It models the predicted lifetime value of a customer based on micro fluctuations in data and dynamically shifts marketing pennies across digital platforms second by second.
That's wild.
It finds hidden pockets of highly profitable users that human marketers would just miss. That's what prevents that standard drop-off in efficiency.
Okay, here is where it gets really interesting. Because the AI isn't just optimizing digital ad spend, it's fundamentally altering the physical shape of the company.
You're talking about the headcount metrics.
Yes. Look at these operational metrics. The in-force premium managed per employee surpassed $1 million.
Which is double what it was in the fourth quarter of 2022.
Right. But at the same exact time, their overall human headcount decreased by 6%. They're operating with just 12,291 employees.
Let's just pause and let that sink in for a second.
Seriously, they grew revenue by 71%, double the revenue managed per employee, and did it while shrinking their team.
It almost sounds impossible.
Are we sure they aren't just, squeezing the skeleton crew?
Yeah.
Like making human adjusters work 80-hour weeks to keep up with the volume?
It's a fair question, but the filings directly address this operational capacity. They credit systemic automation, heavily driven by the integration of large language models.
Right, the LLMs they started integrating in late 2022.
Exactly. We have to think about what an LLM actually does in an insurance context.
Okay, walk me through it.
Instead of a human adjuster spending 45 minutes reading through a vet's messy medical history to verify a diagnosis, then cross-referencing a 50-page policy and manually wiring the money.
Which sounds like a nightmare, honestly.
It is, but the LLM extracts the structured data, verifies the policy limits, and initiates the payout in seconds.
Wow. So the AI automation just absorbs the massive scale of those mundane tasks.
Yes, which secures the team capacity needed to handle the actually complex issues. And the data proves it isn't degrading the experience either. Their customer support metrics actually improved without adding humans.
Okay, so they built this incredibly lean, highly automated machine to acquire customers and process requests. But in the insurance industry, acquiring a customer is actually a massive liability if you price their risk incorrectly, right?
Oh, absolutely. A lean, efficient team doesn't help you if a freak hailstorm wipes out your capital reserves.
Right. If claims wipe out the premiums, The efficiency of the AI just doesn't matter at all.
Yeah.
So let's look at their underwriting performance.
Yeah, top-line vanity metrics mean nothing without sound underwriting. But the bottom line in this quarter tells a very cohesive story. Gross profit surged an explosive 159% year over year.
Hitting $100 million.
Yeah.
And the margins expanded with it. The gross profit margin skyrocketed from 26% to 39%.
And if we connect this to the bigger picture, as a direct result, the net loss shrank significantly.
From $62.4 million in Q1 of 2025 down to $35.8 million in Q1 of 2026, right?
Yes, they cut their losses nearly in half while managing a significantly larger pool of risk.
And what's driving that profitability pivot?
It's the gross loss ratio, which improved from 78% down to 62%.
A 16-point drop in the percentage of premiums paid out in claims in a single year.
It is a monumental shift.
Whenever I see a loss ratio drop that dramatically, my first instinct is to ask if they just got lucky.
Yeah.
Like, maybe there simply weren't any terrible wildfires in California or hurricanes in Florida during this specific quarter.
That's exactly what critics usually say. But the industry relies on specific metrics to isolate luck from actual underwriting skill. The sources highlight two key figures: gross loss ratio, ex-CCAT, and PPD.
Okay, XCAT stands for excluding catastrophes, right?
Exactly. This metric mathematically strips out the unpredictable natural disasters from the equation. And even when you completely remove the weather luck, Lemonade's baseline loss ratio still consistently decreased.
Meaning their everyday risk calculation for like a fender bender or a stolen laptop is just getting fundamentally sharper.
Yes. And the second metric is PPD, or prior period development.
How does that one work?
When an insurance company receives a claim, they set aside a reserve of cash based on an estimate of what it will cost to settle. PPD measures whether the money set aside for past claims was actually accurate as those claims are finally closed out.
Okay, so are they coming in over or under budget?
Lemonade is reporting a decreasing or negative impact from PPD.
Which means the actual final cost of those past claims is coming in lower than their AI originally anticipated.
Exactly. Their internal models were actually being overly conservative. They aren't getting haunted by underpriced risks from 2 years ago.
Man, if you imagine being a traditional insurance executive looking at these numbers, it has to be terrifying.
Oh, they must be sweating.
You spent a century building these massive actuarial departments, and this tech company is suddenly just figuring out the math. The ratio of adjusted gross profit to gross earned premium jumped from 20% to 33%.
It's a crystal clear signal. Lemonade isn't just growing for the sake of venture capital vanity anymore.
No, they're successfully squeezing actual sustainable earnings out of their hyper-growth.
Right. And to truly understand where this profitable risk management is physically happening, we have to look at the product portfolio, because the growth isn't spread evenly across all lines of business.
Let's talk about the breakout stars.
Yeah.
Pet and car insurance. Lemonade Pet is just an absolute monster.
It really is. It crossed $500 million in force premium in under 6 years.
And it's currently the #1 most searched pet insurance brand in the United States.
And the pet division is where you see the most tangible financial impact of that AI integration we discussed earlier. Their loss adjustment expense ratio, or LAE, for the pet division is hovering around 4%.
4%. That is almost difficult to comprehend in this industry. The LAE is essentially what it costs the company in administrative overhead just to process and settle a claim, right?
Yes. And if it's 4%, it means because the AI is handling the medical records and payouts instantly, it costs them practically nothing to administer the system.
I look at that 4% LAE as a massive structural advantage. It's like operating a factory where the electricity is entirely free.
That's a great way to put it.
Because their administrative costs are so fundamentally low, they have this massive financial buffer that legacy companies simply do not possess.
And we can see exactly how they deploy that buffer against their competitors, especially when you look at the rate changes in the market.
Oh yeah. Across the industry, pet insurance companies have been forced to raise their premiums by an average of 27%, just to keep up with exploding inflation in veterinary care.
Right. But Lemonade, they only had to raise their rates by 12%.
Because they have that 4% AI cost buffer, they can just absorb more of the veterinary inflation.
Exactly. They take a much smaller price hike, they keep their customers incredibly loyal, and they still maintain a gross loss ratio of 66%.
Which beats the industry average of 68%. The end result is that their pet division is growing at 55% year over year.
While the rest of the legacy industry is just limping along at 17%, they are growing 3 times faster because the AI makes them structurally cheaper to operate.
It is just a pristine example of utilizing operational efficiency to aggressively capture market share.
But there's a secondary mechanism driving the pet and car divisions that's arguably even more powerful: cross-selling.
The documents reveal that $85 million of the pet in-force premium comes from what management calls CAC-free cross-sales.
And CAC-free meaning zero customer acquisition cost.
Right, $0 spent on marketing for those users. How does that work in practice?
Think of the Lemonade ecosystem as a walled garden. Once you pay the initial marketing toll to get, say, a young renter inside that garden, you own the relationship.
Okay.
When they eventually adopt a dog or buy a vehicle, you seamlessly upgrade them to pet or car insurance directly within the app interface.
You don't spend a single dime on Google search ads or TV commercials to acquire that massive new stream of premium.
Exactly. It compounds your top-line revenue while your marketing expenses remain completely flat. The holy grail of profitability.
And that dynamic is clearly supercharging Lemonade Car as well. The car division's in-force premium is suddenly growing at 60% year over year.
That is a massive acceleration. Just a short while ago, that growth rate was hovering at an anemic 3%.
Now they're hitting 60% growth. They're maintaining a very healthy 74% gross loss ratio and direct-to-consumer new business,
Driven largely by those zero-cost cross-sales.
is growing at over 100%. The state of Colorado has actually exploded to become their fourth largest market overall.
Which brings us to the ultimate metric of financial health.
Show me the money.
Right. We've outlined massive revenue growth, a lean automated workforce, tightening loss ratios, and highly lucrative zero-cost cross-selling. But all of those individual data points have to culminate somewhere on the balance sheet.
Everything else is just theory until it hits the bank account.
Exactly. And for years, the primary criticism levied against Lemonade by institutional investors was that it was an artificial business kept alive only by continuous infusions of venture capital.
Right, the idea that it burned cash just to survive.
But in Q1 2026, their adjusted free cash flow turned definitively positive. They generated $17.4 million in positive free cash flow from their operations.
That is a staggering turnaround when you realize they were running at a negative $31 million in the exact same quarter just 1 year prior.
This raises an important point. This is the ultimate milestone for a disruptive tech company. This marks 5 consecutive quarters of free cash flow growth.
It signifies a shift from surviving on external life support to generating internal metabolic cash.
Their own day-to-day operations are now entirely funding their growth initiatives. And when you combine that positive cash generation with total cash and investments sitting at a fortress-like $1.14 billion,
their balance sheet is remarkably insulated from external market shocks.
Very insulated.
And you can clearly see the swagger in their future guidance. Management isn't hedging their bets at all.
No, they're leaning in. For Q2 2026, they expect IFP to hit between $1.428 billion and $1.433 billion.
And for the full year, they are projecting 33% IFP growth. Furthermore, they're confidently stating that the positive trend in adjusted EBITDA will continue unabated through the end of 2026.
They are officially on a steady, mathematically sound march toward a fully positive adjusted EBITDA year.
When a management team provides guidance that is both highly specific and deeply optimistic, it indicates profound internal trust in their AI predictive models.
They truly believe the machine has successfully mapped the terrain of the insurance market and all the bad surprises are behind them.
And they are ready to show those blueprints to the world. They've announced a major investor day in New York City, scheduled for November 17th.
Oh, you don't rent out a venue in NYC and invite the most ruthless financial analysts on Wall Street to a live presentation unless you have a completely bulletproof narrative to present.
Definitely not. It's positioned to be a massive victory lap based on the underlying unit economics proven in this quarter.
So what does this all mean when we put the pieces together?
Well, the absolute trifecta that Lemonade pulled off in the first quarter of 2026 is pretty remarkable. First, they scaled their revenue massively by strategically keeping more risk on their own books.
Right. Second, they maintained perfect marketing efficiency against all traditional odds through real-time AI capital allocation.
And third, they achieved this massive scale while actively shrinking their human workforce through systemic automation, all of which led to the ultimate validation: their first positive free cash flow.
It comprehensively validates their core thesis. An insurance company built from the ground up on a digital AI-first substrate can operate at a fundamentally different margin profile than a legacy carrier burdened by century-old infrastructure.
Absolutely. We have spent this entire deep dive marveling at the sheer capability of this machine.
Yeah.
But I want to leave you with a final, slightly provocative thought to mull over.
Okay, listening.
It's based on a very subtle detail buried deep in the source material. We talked extensively about how the AI is working absolute miracles in the car and pet insurance segments, right?
The numbers there are undeniable.
But the data also noted that in the Europe and homeowners segments, Lemonade is still exhibiting higher volatility and slight loss increases.
So the predictive models are clearly not infallible across every single geographic or product line.
Exactly. Which raises a fascinating question about the limits of technology. It's abundantly clear that an algorithm can perfectly calculate the lifetime medical value of a golden retriever, right?
Or precisely underwrite the risk of a driver based on a telematics device monitoring their braking habits.
Yes. But can an LLM truly tame the unpredictable, highly localized regulatory chaos of European markets?
That's a very different kind of problem to solve.
Or even more importantly, can an algorithm accurately price the wildly chaotic, unprecedented impact of global climate change on homeowners insurance?
Can an AI predict a 500-year flood event that suddenly happens 3 years in a row?
Exactly. Ultimately, will the sheer unpredictable chaos of the physical world eventually outsmart even the most sophisticated large language models?
It really is the ultimate boundary test for the company. Code versus climate.
Something to keep in mind the next time you look at a sleek green digital dashboard promising perfect efficiency. Thank you for joining us on this deep dive into the numbers. Keep questioning the data, and we will see you next time.